Well, good afternoon to everybody, and thank you for joining this tax talk from the Nebraska Chamber. It's an appropriate day for this conversation. We have tax legislation in the legislature as we speak today, historic potential tax reduction legislation. But what I really wanted to talk about a little bit today, we're just going to spend 30 minutes quickly from a policy standpoint, talking about some of the realities and the differences between state taxation and federal taxation policies, because it really affects how we view what goes on in the legislature. I think we're much more familiar with federal tax policies than we are state tax policies. So we're going to spend just a little bit of time on that, just background, and hopefully have some time for some Q&A at the end. So Jenna, if you could move me to the next slide. In terms of specifically what we'll talk about today, I'm gonna talk about things that are the same, that things are in common between federal and state tax policy, but then spend some time on some specific differences. And you can see them there. And so Jenna, if you would take me to the next slide, let me just start talking about what is common between tax policies. You think it on the federal level and the state level. Certainly the goals of effective tax policy are the same, both federal and state at a very high level. Generally speaking, when we talk about tax policy, what we're looking for is fairness, simplicity, and economic growth. In both cases, fairness meaning that generally that's come to be known in the United States, at least, as having somewhat of a progressive system where you pay a little bit more as you go up higher in income levels, but fair as between taxpayers and geographies and industry segments. It's never perfect. But the goal is to make it fair and not have situations in the tax code that are patently unfair to any particular group of people. We can talk about that a little bit as we get down the road here. Simplicity, we're going to talk about this in a bit as we get to tax administration. In truth, both at the federal and the state level, one of the greatest threats to the effectiveness of our tax system and the revenues we collect is when it gets too complex for people to understand. And generally speaking, as tax systems become more complex, you see voluntary compliance go down. And it only takes very small numbers in changes in voluntary compliance to change the effectiveness of a tax system. And then the third piece is economic growth. Ultimately, we're always talking about a tax system that at least doesn't get in the way of economic growth. Ideally, it would encourage economic growth, but at least doesn't get in the way, which really leads to, again, same on the federal and state side. In my case, in many economists' case, we view taxes as a bit of friction in the economy. Clearly, the economy would develop and grow faster in a world without taxes, and taxes are always a friction point in the economy. And basically, at that friction point, the general rule of thumb is what you tax more, you're going to get less of. And so if you tax one particular income group too high, you're going to get less of that income group. Or if you tax one industry too high, you're going to get less of that industry. And there tends to be, over time in a capitalist society, a very much a capital allocation element to this too. Whatever you tax more, you're going to get less capital allocated to. And that really comes to the second piece. The best tax systems, both at a federal and state level, generally tend to be a broad base without a lot of special exemptions and a low rate. That broad base gets you to the lowest rate possible. That means the market is allocating capital between industry segments, and ultimately capital is flowing to the most profitable, economically profitable areas in the business world, rather than being dictated by the tax code. So far, the free market is 100 to 0 against sort of government allocated capital allocations. The free market is always more efficient over the long run. Two other things that I'm going to talk about in terms of both state and federal is the law of big numbers. And I noted this before, that so if at the federal level, if you have a voluntary compliance rate, and let's say that the voluntary compliance rate, meaning the rate at which taxpayers currently file their returns accurately, purely voluntary because there's very low rates of audits, and let's say that's 92% now, just a simple change from 92% to 88% or something like that would truly mean millions and millions and millions and millions of dollars of tax collections. It's also true at the state level, where we have a state budget of over $4.5 billion. Just small changes in voluntary compliance can add up to really big numbers. And so the goal of the tax system always has to be to encourage voluntary compliance. And then corporate taxes. Corporate taxes are sort of double trouble. And we all know it because that income's taxed twice, once at the corporate level and once at the individual level. And so that income bears a particularly high rate of tax and is inefficient and uncompetitive, particularly if the rate, as is in the case in Nebraska, but not at the federal level, if the rate of corporate taxes, the initial rate on corporations, is higher than the individual rate, and then you come back and you tax the dividends again later on at an individual rate, that creates a pretty big gap, particularly in between flow-throughs and corporations. Not a great tax policy situation, both in terms of the excess friction that's caused on the economy, but also just from a fairness standpoint, that if a flow-through organization and a corporation are engaged in exactly the same conduct of business with exactly the same profitability, it's really hard to justify why one is taxed greatly more than the other. So generally, what we would like to see is corporate tax rates at least as low as the individual and possibly lower. So turn to the next page, Jen, and I'm going to talk about some of the differences. One of the biggest, obviously, is deficit spending, which can occur at the federal government, as we're all aware. The federal government doesn't need to make its tax bills always balanced. Certainly, they have put in procedures in the past at times that required a revenue neutral tax bill, but as an example, the last Trump tax bill was not revenue neutral and created deficit spending, at least on a static basis. And let me talk about static versus dynamic forecasting. Typically, both at the federal government and at the state government level, they estimate the effects of any tax legislation on a static basis, meaning they take all the current revenues and current assumptions and they just take a flat, what would this bill change without any consideration of potential economic growth being derived from better capital allocation or asset accumulation or even workforce changes that would result from the tax bill. People have been arguing for dynamic forecasting for years and years and years, but as a practical matter, most of the revenue forecasting that is associated with any tax bill is still static. At the federal level, though, this deficit spending is sort of a de facto way to get to dynamic forecasting. So again, with the Trump legislation, President Trump had a view that if you reduce the corporate tax rate to something that was truly competitive internationally, which it became, that you would have a huge amount of growth in the economy, given the size of the corporate community and the corporate community's contribution to GDP, and then how it would relate with multinational corporations. For the most part, that turned out to be true. And so being able to deficit spend at a federal level allows you to take into consideration, at least indirectly, some of the dynamic forecasting effects on the economy. That's not true at the state level. And the state is still using static models. What it does is sort of change the atmosphere in which we do state policy work compared to federal policy work. Generally speaking, every state bill is going to have to be revenue neutral when you do a big comprehensive tax bill. And it creates what I call the dividing the pie syndrome, which is, or some people refer to as the three-legged stool. They're either taking from sales tax to lower property taxes, or you're taking from property taxes to lower income taxes, or you're taking from income taxes to lower property taxes. But one way or the other, in many respects, in a static model, you're just shifting the tax burdens from one group of taxpayers to the other if you don't recognize the economic growth that can come out of something. And that's indeed happening right now for well over a decade. We've gradually been shifting the property tax burden, which is excessive, back to sales and income taxes, but it's primarily been a tax shifting exercise rather than an economic growth exercise. And so this is a struggle when we have tax bills, and indeed that's a lot of the debate on the floor of the legislature today, is whether this tax reduction will create the growth that's needed to continue to fund the revenues. All indications are that it will, but we're working with static models in the legislature. Turn to the next page, Jenna, please. A huge difference between federal policy and state policy is considering the tax administration resources, because whatever system you build, you have to administer. We have a piggyback system here in Nebraska on the income tax side. It's very smart that we do. The Internal Revenue Service now has 75,000 employees. When I worked there, we had over 100,000 employees. So the Internal Revenue Service has actually gotten smaller in terms of employees. It has a $12.3 billion budget. By piggybacking our income tax system with the federal system, we have the benefit that the bulk of the tax administration, even for our state tax system, is really run by the Internal Revenue Service. We simply get the results, for instance, of Internal Revenue Service income tax audits that are shared with the state and then trigger the same adjustments at the state level. That's a lot of our income tax audits. And so we require a much smaller budget and many fewer employees to administer our income tax than if it was a separate income tax system, totally different than what the federal system is. And this is a big deal. And generally, we should stay piggybacked within the state. It also helps in terms of compliance because the IRS is very good at generally about putting out guidance. And when those same terms and those same definitions apply at the state level, we're not having to chase additional guidance at the state level. Where we do have systems at the state level that are not piggybacked, and those would be the property tax and sales tax, then there has to be a separate state administration system. And anybody who's been through a Nebraska state sales tax audit is well aware of how difficult those audits could be. There is a proposal in the legislature this year to create what's called the EPIC tax, or a consumption tax, similar to what the Europeans have, to replace the other systems. Just understand with this one, from just a tax administration standpoint, I'll talk about it in other webinars in terms of what some of the other policy ramifications are, but just from an administration standpoint, at one point in the 80s, the Internal Revenue Service was presented with a question of what would it take to enact a consumption tax like Europe in the United States. The estimate was that it would take four years and literally millions and millions and millions and millions of dollars to create that system. It's a gigantic sales tax with a potential export exemption that would have to be transaction based. And in order to create the audit trails on that, you would have to have a pretty big agency, which the European governments do, and conformity in terms of how you dealt with different industries. Were we to enact a consumption tax in Nebraska, it would be a huge administrative cost, and it would take literally years to develop that system. So let me turn to the next page, if I could. Now we get to really the core of what's different about how you think about states and how you think about the federal government. And it really depends on how you view the level of the threat of outmigration of both population and businesses due to income tax concerns, both at the federal level and the state level. At the federal level, historically, we have not had a huge concern about outmigration of people or businesses to other countries because of our income tax system. Now, there was a period of time before the Trump legislation where multinationals were starting to take a look, and several large ones did in fact reincorporate in other countries. And that was starting to become a pretty significant tax policy question, because our corporate rates in the United States were just simply not competitive anymore. But outside of that one instance, and since the Trump Act, there's been very little of that. There's not much of a threat that US citizens are going to renounce their citizenship and move to tax havens otherwise. It happens, I'm sure, in certain cases, but the numbers are not large. And indeed, in terms of population, if you look at this left graph, the green line is the United States. We have no lack of population growth in the United States, but if you look at Nebraska from 1960, which is the blue line, to 2020, we have much lower population growth in Nebraska over time than we do at the US level. And so we do have a greater threat at the state level. And in many respects, Nebraska, like any other state, we're competing against all other 50 states, both for people and businesses, every day of the week. And outmigration is very easy. It's very easy for an individual to move to Florida or Texas with zero, or even a South Dakota with zero income tax rate, or businesses to move, particularly in this day and age. And so at the state policy level, we have a much stronger issue of outmigration, and it affects everything that we should be looking at, and we should be constantly comparing ourselves to peer states as to what our rates are and what our methods of administration are to be competitive. And that is the issue. And if you ask me in the legislature this year, is what are we going to do to be competitive? We have 20 states now in the United States who are looking to develop a very low income tax rate, 3% or even down to 0%. In the next period of years to be competitive. That is going to become the table stakes. We at the current point have 6.84% income tax rate and almost a little over a 7% corporate tax rate. So we do have a much greater threat of outmigration in Nebraska. Turn to the next slide, Jenna. The other issue is capital versus workforce attraction. At the federal level, most of our tax code is built around capital attraction, and for decades, capital attraction has and will continue to be a traditional federal policy focus. And by what I'm talking about is attracting global companies and national companies to invest in the United States rather than invest in other places. And so we have a lot of provisions in the federal tax code. In fact, it's designed very much to develop capital attraction. We have things like capital gain rates and lower taxes on interest and dividend income. All of that is built around trying to track capital formation, accumulation, and then actually the investment of capital in the United States. That's also important at the state level, but more important for Nebraska at this point, and actually the other 50 states, is this workforce issue, which has suddenly become the #1 issue for all states, and certainly for Nebraska right now. Our issue is not capital attraction so much in Nebraska. We still want to attract capital and investment and jobs, particularly in the technology centers, sectors, but the workforce issue is now critical. And so as you think about what does a tax code look like that attracts 18 to 34-year-olds, and is it different than the ones that we've had for 30 or 40 years? And I'd say absolutely. The tax code should be different. And so we need to think a lot about people at the beginning of their careers and how the tax code affects them. Now, most people would say, and I think it's right, I think it was true when I was 20, which seems like a long time ago, we're not looking at our paychecks carefully. And so it might not be income taxes as much, could be. Generally, I find young people pretty smart on taxes at this point, but it's also cell phone taxes and internet taxes and those sorts of things. And how do we become competitive? And it's certainly something Nebraska is going to have to pay a lot more attention to. And then if you turn one more slide, Jenna, the last difference that I really want to highlight between state and federal is this consumption and property taxes. So in the federal realm, we're generally collecting through excise taxes, import taxes, and duties and income taxes. At the state level, property taxes play a big role, as do sales taxes. So this pie chart on the right is the state's budget from 2019 to 2020, but it's generally indicative of what we have now. Basically, at the state level, we raise and spend $4.5 billion. We also raise and spend another $4.5 billion at the local level through property taxes. So this is the state level, and you can see the bulk of it is income taxes, but there's a very big chunk that's sales and use taxes, and that consumption taxes on the personal consumption of individuals is a big chunk of our state budget that doesn't have the equivalent at the federal level. When you add the over $4 billion of property taxes that we collect in this state, it's always a mix, and it's always a question of how do we balance this mix against other states. Right now, as a state, we are at the lower end of sales tax collections per capita. We're at the mid to high range on income taxes, and we're definitely at the high range on property taxes at this point. And so there needs to be a rebalancing, but in the context of that rebalancing, we need to think about both the workforce issue and the economic growth issue and its effect on people. And the question of, are we attracting young people? Are we attracting families? Are we attracting workforce? And where does that come from? That's very different than the federal issue on income taxes. And so we will be having these conversations, I suspect, for the next decade. So last slide, Jenna, and then we'll take some questions. What's this mean and where do we go from here? Well, we've got legislation on the floor today, which would basically reduce our tax rates by 1%, not one, just a 1% from 6.84 to 5.84. That 5.84% would still make us the highest income tax state by rate in our region. Excuse me. With Iowa recently going to a 3.9% flat tax. We clearly need to each year try to reduce our rates to something that is still competitive with our surrounding states, at least South Dakota, Wyoming, Colorado, Kansas, Missouri, Iowa, and South Dakota, because we are going to be the highest state in the region even if we pass this legislation today, and so we need to continue to make that effort. Blueprint Nebraska came out with a tax modernization proposal earlier this year. I suspect that will become a significant proposal next year in the legislature. And what it would do would include some rebalancing, not just reduction of rates, but some rebalancing by eliminating some sales tax exemptions and using those funds to further reduce income taxes, and then to take some of the sales tax windfalls that would come to the local communities through that, and then also reduce property taxes. The goal would be part shifting, part economic growth. And what Blueprint Nebraska would like to envision would be somewhere around a 4% flat tax. And by a flat tax, meaning you wouldn't have itemized deductions anymore as individuals. It would be 4% against your adjusted gross income. But that still would be a pretty significant reduction from our current rates. It involves a rebalancing of these events as well. We've seen a lot of this kind of thing now for about 10 years, starting with North Carolina, which had a very successful program, similar program. We're seeing it in other states, and we're actually seeing it most recently a pairing of approaches. One, a blueprint type approach where they do broaden the base and reduce the rates primarily with sales taxes, but also other legislation taking excess revenues, which most states have right now, excess revenues because the economy is doing well. And anytime there's excess revenues, finding a way to scrape those revenues and or at least a portion of those revenues and reduce tax rates. When those two things work in concert, that seems to be working well. I can point to a state like Utah, which has been doing this very, very successfully. I talked about the epic consumption tax proposal. I don't think we can go to a complete sales tax or consumption tax effort to raise, because it would have to raise not only the $4.5 billion at the state level, but the $4.5 billion that is now raised in property taxes. A $9 billion tax, if it were only to apply to individuals and their consumption, would probably be at least a 15 to 20% tax. That would make us uncompetitive, and people just simply wouldn't buy products in Nebraska. And so that's not going to work. Otherwise, you would have to actually put a sales tax on businesses, and that would be uncompetitive as well. I think where we go from here as a state, and where we're going to be going as a chamber, is a pretty deep review of all our competitor states. We've done that in the past, but I think we're going to create a little more rigor around that process, and making sure that we're competitive. And I think we're going to be looking to be competitive on basically three fronts. We're going to continue to look to be competitive in terms of capital attraction, but we're also going to be looking to be competitive based upon our peer states and the systems that they have, to make sure that we're not completely out of whack in one area, like a property tax or an income tax. And then lastly, we're going to have to take a hard look at does our tax system make us more or less able to attract workforce compared to these other states? I think those three questions are gonna drive the tax policy debates we have not only today in the legislature, but through the next 5 years, with that workforce component continuing to get bigger and bigger and bigger. And so with that, Holly, I'm unable to see the chat. So if there are any questions that people have put into the chat or would like to put in the chat, I'd be happy to take any.
Ryan, one quick question. Comment a little bit more on the types of tax policies that can be helpful in recruiting some of our younger talent.
Yeah, so I think when you're talking about younger people on just on the income tax side, so one of the biggest issues they have is actually moving expenses and moving from one state to another. And so I think creating a more attractive moving expense type of credit or deduction makes a lot of sense. I think there's issues in terms of student loan forgiveness that could apply, and some states are taking a hard look at that. But actually, one of the things that's attracting young people right now is technology companies and innovation. They're very much more attracted to states that look like they're having a robust economy, particularly in the technology area. So I actually believe very strongly that research and development credits and technology type incentives to bring more technology companies to the state, particularly related to our core sectors like agriculture and manufacturing and finance and insurance. If we were to really encourage the large tech companies to have a much larger presence in Nebraska, that would also pick up our 18 to 34-year-old workforce. And so those, from an income tax standpoint, those are some of the things we could do. But I think we have to look at other taxes as well. For a young person just out of college, things like cell phone taxes and internet taxes are just as important. And we need to be a little more holistic in terms of how we approach that.
Brian, that looks like to be all. We appreciate your time today, and thanks everyone for joining.
No, thank you, everybody. Appreciate it, and keep your eyes on this tax debate in the legislature today, and hopefully good things for Nebraska.